Welcome to Breaking News to Trading Moves. We're looking today at a market that feels, well, pretty tense. You've got this rising concern about a potential U.S. government shutdown, creating a lot of caution,
Risk aversion.
definitely caution. And then, on the flip side, you see the market really leaning hard into the idea that the Fed's going to cut rates, maybe even sooner than we thought.
Right, accelerating that timeline.
Exactly. And that tension, it's not just talk. It led straight to a major market event, the big headline. Gold. It hit a new record high.
A record.
Yeah, specifically $3,895 per ounce spot price. And it wasn't in a vacuum this happened right as ADP reported a drop in private payrolls, which adds to that softer economic picture.
Okay, so weaker jobs numbers.
And a weaker U.S. dollar at the same time. It all kind of came together.
So our aim here is to look at the immediate fallout from all this. We're drawing on recent market analysis to see, okay, who came out ahead? Which companies, which sectors benefited right away? And just as importantly, who felt the pressure? Which companies faced some headwinds from this combination of factors? We're going straight to the winners and, well, the losers in this setup.
Okay, so before we get to the winners and losers, let's just nail down the conditions, the forces that actually created this market move. It feels like a few key things lined up perfectly, or maybe imperfectly, depending on your view.
That's a good way to put it. There are about four main drivers acting together here.
All right, what's number one?
Number one, you just have to look at the gold chart itself, the price action. Spot gold hitting that $3,895 mark. That's not just a number.
No, it signals something.
It signals conviction. It tells you capital is actively looking for safety outside of, government debt.
Yeah.
It's that classic fight to safety. But hitting such a high number shows real strength in that move.
Okay, so gold's price itself is factor one. What's driving the future outlook? That's number two.
Number two is all about monetary policy bets. The market isn't just hoping for a rate cut anymore. It's pricing it in as almost certain, like for the October Fed meeting.
And that expectation got pulled forward, right? Accelerated.
Exactly. It's accelerated by the very things we mentioned, the political uncertainty, the shutdown risk, and the softer economic data points. The market's essentially shouting at the Fed, hey, things are looking weaker. We need that cheaper money sooner.
Which brings us to number three, the data itself.
Precisely. Condition number three, the economic data. That ADP report showing private payrolls falling, that's concrete evidence.
Yeah.
It suggests the job market, which has been, pretty strong, might be cooling off faster than people expected. And for the Fed, weaker jobs data gives them both a reason and maybe even a need to ease policy, especially if they want to avoid a hard landing.
So bad news on jobs becomes good news for rate cut bets.
Instantly fuels that narrative.
Yeah. Okay. And the fourth piece.
The fourth piece is the currency. Condition number four, the dollar. The U.S. dollar weakened against other major currencies, and this is crucial for commodities like gold.
Because gold is priced in dollars.
Always. So when the dollar gets weaker, gold automatically becomes cheaper for anyone holding euros or yen or whatever, whether it's a big fund in London or a central bank in Asia.
So it adds another layer of buying pressure.
It adds structural support, amplifying the gains that were already happening because people were nervous and seeking safety.
Okay, let me see if I can summarize. You've got nervousness driving people to gold.
Risk off.
You've got weaker data suggesting the economy's slowing.
Yep.
Which makes the market bet heavily on the Fed cutting rates soon.
Cheaper money coming.
And a weaker dollar makes gold cheaper for foreign buyers anyway.
You got it. That's the combination. Risk off plus the expectation of cheaper money. And that specific mix dictates where the money flows next, away from some sectors and straight into others.
Okay, so when the market gets cautious like this, and everyone expects borrowing costs to drop, certain assets just naturally attract money. Let's look at the companies that analysis shows are benefiting right now, where higher gold prices or lower expected rates are a real advantage. Hashtag tag 2.1 gold miners and royalty companies. Naturally, the first place to look is the gold miners themselves. I mean, the stuff they sell is suddenly worth a lot more, but you mentioned it's often a double benefit for them.
Yeah, it hits them in two positive ways, almost immediately. First, there's the obvious one, the direct price uplift.
Right, simple math.
Pretty much.
Yeah.
Think about their cost to dig an ounce of gold out of the ground. Labor, fuel, equipment, all that. Let's say it costs them, $1,500 an ounce.
Okay.
If gold was trading at $2,500, they made a $1,000 profit per ounce. Simple. Now suddenly gold is near $3,900. Their costs didn't jump overnight.
No, costs are stickier.
Exactly. So their revenue per ounce just soared. That difference drops straight to their operating margin, boosting cash flow right now in this quarter. It's direct leverage to the gold price.
Makes sense. Pure profit boost. But what's the second benefit? Something about their reserves. How does that work?
Right. This is maybe less obvious, but important for their valuation. The second benefit is the increase in reserve value.
The gold's still in the ground?
Exactly. These companies, especially the miners, but also the royalty guys we'll get to, they're valued partly on the gold they plan to mine in the future. They're proven and probable reserves.
Okay.
When the market price of gold jumps like this, the estimated value of all that gold they haven't even touched yet goes up too. It makes their balance sheet look stronger, boosts their net asset value, makes them look, healthier financially.
Ah, okay. So it helps today's profits and tomorrow's perceived value.
You got it. And remember, this is all happening while the market is also betting on falling interest rates.
Yeah, let's connect those dots. The monetary angle. Why does the expectation of lower rates help gold so much? It doesn't pay any interest itself.
That's the key right there. It doesn't pay interest. It's all about opportunity cost.
Oh.
Think about the last couple of years. You could stick your money in a U.S. Treasury bill, get a guaranteed pretty decent return, right? Maybe 5%, 5.5%.
Risk-free, yeah.
So if you chose to hold gold instead, which pays 0, you were giving up that guaranteed 5.5%. That's the opportunity cost, the return you missed out on.
Okay, I'll follow.
Now, fast forward to today. The market is betting the Fed will cut rates, maybe down to 4% or lower eventually. Suddenly, that T-bill yield doesn't look as good. The return you're missing out on by holding gold instead, it just got smaller.
Ah, the penalty for holding gold decreases.
Precisely. The opportunity cost drops. And when the cost of holding a safe asset goes down, big institutional investors, pension funds, whoever, they find it much more appealing to allocate money to gold. They offer safety, potential price gains, and now the yield you're giving up elsewhere is less painful.
So the rate cut expectation acts like fuel on the fire for gold demand.
Works hand in hand with the nervousness we talked about. It's a powerful combo.
And this applies to the big miners we know, like Newmont, ticker NEM,
Yep.
and Barrick Gold, GoldLD.
Definitely. They get the full operational leverage plus the reserve value boost and benefit from this lower opportunity cost environment.
What about the royalty companies? You mentioned them, like Royal Gold, RGLD, and Franco-Nevada, FNV. How are they different?
They have an even cleaner exposure in some ways. Their model is different. They typically give money to a miner upfront, and in return, they get a percentage of that mine's future gold production or revenue, sometimes for the life of the mine.
So they don't operate the mines themselves.
Right. They have much lower operating costs and risks. Once their deal is set, if the price of gold goes from $2,500 to $3,900, that increase flows almost directly to their top line, their revenue from that royalty or stream.
Ah, pure price exposure without the mining headaches.
Kind of. It's very high margin leverage to the commodity price itself. That's why investors often like them when they expect gold prices to rise strongly. Hashtag tag 2.2 silver miners.
Okay, so gold miners are clear winners. But the analysis also mentions silver rallied hard, hitting a 14-year high. Silver's used in industry too, right? So is it just tagging along with gold for safety, or is there more to it?
That's a great question. Silver's rally really shows its kind of dual nature. Yes, part of it is tracking gold. Historically, when investors get nervous and look for hard assets, they often buy both gold and silver.
So the lower opportunity cost helps silver too.
Absolutely. Same logic applies. If rates are expected to fall, holding non-yielding silver becomes less costly relative to holding bonds or cash.
But what's the other part, the industrial side?
Yeah, that's the other element. Gold is mostly seen as money or a monetary asset. Silver, maybe about half of its demand, comes from industry electronics, solar panels, medical uses, things like that.
Okay.
So when the market anticipates rate cuts, it's not just about safety. It's also betting that lower rates will eventually stimulate the economy, right? Cheaper borrowing costs could lead to more investment, more manufacturing.
More demand for industrial materials like silver.
Exactly. So silver gets a boost from the safe haven trade like gold, plus it gets a potential kicker from the expectation of better future industrial demand fueled by those very same rate cuts.
Huh. So it's like a double whammy for silver in this specific scenario. Safety now, potential growth later.
That's a good way to think about it. It combines those two narratives. And that helps explain why the silver miners, companies like Pan American Silver, ticker PAAS, and Hecla Mining, HL, perform so well. They get the higher silver price now, plus this optimistic outlook for future industrial use. Hashtag tag 2.3 rate-sensitive real estate investment trusts, REITs.
All right, let's shift gears from metals to property. The analysis highlights rate-sensitive real estate investment trusts, REITs, as beneficiaries. Now, these companies are known for debt, right?
Yeah.
And dividends. Why exactly does the expectation of lower rates help them so much?
You hit the nail on the head. Debt and dividends are key here. REITs essentially own and manage properties, and they use a lot of borrowed money leverage to buy those buildings.
Mhm.
So lower rate expectations bring like three main benefits.
Okay, what's the first one?
First is just straight up financial relief. Lower financing costs. REITs are constantly borrowing money, refinancing existing debt, or taking out new loans to buy more properties.
Sure, it's capital intensive.
Very. So if the market expects rates to fall, the anticipated cost of all that borrowing goes down. That means lower interest expense on their income statement. It improves their cash flow directly, makes their operations more profitable, even if rents stay the same.
Makes sense. Cheaper debt is good for borrowers. What's the second benefit? You mentioned something about property values.
Yeah, this one's a bit more indirect, but really important. It's about cap rates and valuations.
Okay, explain cap rates.
Right. A cap rate, or capitalization rate, is basically a measure of the expected return on a property investment. Think of it like a yield. You calculate it by taking the property's annual net operating income, the rent minus operating expenses, and dividing it by the property's market value or purchase price.
Okay, income divided by price.
Yep. Now, cap rates tend to move inversely to interest rates. When interest rates go up, investors demand a higher return, a higher yield on other assets, including property. So cap rates have to go up too. For the cap rate to go up, given the same income, the property's price has to go down.
Ah, okay. Higher rates push property values down through higher cap rates.
Exactly. But now flip it. The market expects rates to fall. That means the required return, the cap rate investors demand, can also fall, or at least stabilize. If the cap rate goes down for the same amount of income, what happens to the property value?
It goes up.
It goes up, or at least stops falling. So lower expected financing costs support lower cap rates, which directly boost the valuation of the billions of dollars worth of real estate these REITs already own. It's a big lift to their asset base.
Wow. Okay, so cheaper debt service and their existing assets look more valuable. That's powerful. What's the third leg? Dividends.
The third benefit is dividend sustainability. REITs have a special structure. They're legally required to pay out most, usually 90%, of their taxable income as dividends to shareholders. That's why people buy them for the income.
Right. High payouts.
So when their financing costs go down, as we discussed, they have more net income left over after paying their interest expense. This makes it easier for them to cover those mandatory dividends. The dividend looks safer, more secure.
And in a world where yields on safe things like T-bills are expected to fall.
A high, reliable dividend from a REIT becomes much more attractive to income investors. It's exactly what they're looking for.
So companies like Realty Income, Picker O, they're famous for monthly dividends, right? And American Tower, AMT, which owns cell towers and needs debt for expansion, they'd be prime beneficiaries here.
Precisely. Those are classic examples of REITs that are sensitive to interest rate movements and have substantial dividend payouts. The shift in rate expectations is a clear positive for them. Okay, so we've seen who benefits when markets get cautious and expect cheaper money. But those same forces, well, they create problems for other sectors. They act as headwinds, particularly for businesses that rely on higher rates, or those that depend heavily on consumers feeling confident and spending freely. Hashtag 3.1 large U.S. banks.
All right, first up in the pressure zone, the big U.S. banks. This feels a bit counterintuitive at first glance. Wouldn't cheaper money eventually help banks lend more? Why does the prospect of faster rate cuts actually hurt their profitability right now?
It really comes down to how they make money, specifically their net interest margin, or NIM. That's the core profit engine for most banks.
The spread between what they earn on loans and pay on deposits.
Exactly. Now think about what happened when rates were rising quickly. Banks could jack up the interest rates on loans pretty fast, right? Mortgages, business loans, credit cards.
Yeah, those went up.
But they were much slower, much stickier about raising the rates they paid you on your savings account or checking account. That gap widened.
Right, the NIM expanded. Good for bank profits.
Very good for profits. But now the market expects rates to fall, and maybe fall quickly. The whole process goes into reverse. Banks feel pressure almost immediately to lower the rates they charge on new loans to stay competitive and attract borrowers. Variable rate loans also adjust down.
Okay, loan rates start to drop, but what about deposit rates? Can't they just cut those equally fast?
That's the problem. It's not symmetrical. The market for deposits is incredibly competitive. If a giant bank like JP Morgan Chase, that's JPM, slashes its savings rates too quickly,
People will move their money.
instantly, to a smaller online bank offering a better rate, or into a money market fund. The big banks need to keep those core deposits. It's their cheapest source of funding. So they can't cut deposit rates as aggressively as lending rates are expected to fall.
So there's a lag. Lending rates fall fast, deposit rates fall slow.
And that lag compresses the net interest margin. The spread shrinks. That directly eats into their main profit source. That's the primary hit from accelerated rate cut expectations.
Okay, NIM compression. Makes sense. But the analysis also mentioned the government shutdown risk hitting banks like Bank of America, BAC, and Wells Fargo, WFC. How does that add to the pressure?
That's the second layer. It hits loan growth and just general risk-taking. When there's major political uncertainty, like a potential government shutdown, businesses get nervous.
They pause investment.
They pause investments, delay expansions. That means less demand for corporate loans. Consumers also get jittery. Maybe they put off buying a house or a new car. The less demand for mortgages and auto loans.
And if a shutdown actually happens,
Then you have federal workers potentially missing paychecks, government contractors facing delays. That could lead to temporary difficulties in people paying their existing loans, maybe even small increases in defaults. It just dampens the whole lending environment.
so it's a double whammy for banks. Lower profit margins on the loans they do make, and potentially fewer loans being made overall because everyone's more cautious.
Exactly. Lower margins and lower volume. Puts them squarely under pressure in this kind of environment. Hashtag tag 3.2, jewelry retailers and watch brands.
Okay, moving from finance to retail. Jewelry stores and watch brands were also listed as facing pressure. Why would high gold prices hurt them? Doesn't it make their inventory more valuable?
You'd think so initially, but it's all about input costs and timing. For a jeweler, gold isn't just an asset, it's their raw material.
Right, it's what they use to make the product.
Exactly. So when the spot price of gold jumps, say, hundreds of dollars an ounce very quickly, like it did, the cost for them to buy new gold, to make new rings, new chains, new watch cases, it skyrockets almost overnight.
Okay, their cost of goods goes way up.
Way up. But here's the crucial part. They usually can't just pass that entire cost increase onto the customer immediately. It's about pricing power, or rather, the lack of it in the short term.
They can't just hike the price tag on a necklace by 25% tomorrow.
Not really. Especially not in the luxury or semi-luxury space. Consumers push back. Pricing changes usually take time, involve marketing, maybe happen gradually. They can't just re-sticker everything overnight to match the new gold cost.
So let me get this straight. They bought their current inventory when gold was cheaper.
Right.
They're selling it now, maybe with a small price bump.
Maybe.
But the gold they need to buy today to replace that inventory costs way, way more.
You nailed it. That creates immediate and frankly painful margin pressure. Their profit margin on the stuff they sell next, and especially the stuff they need to restock, gets squeezed really hard.
So while the gold miner is celebrating wider margins,
The gold retailer, like Signet Jewelers, ticker SIG, or Movado Group, MOV, they're facing shrinking margins. They have to absorb a big chunk of that commodity price shock themselves, at least in the near term, to keep customers buying. It's a total divergence based on where you sit in the supply chain. Hashtag tag 3.3 airlines and travel cyclicals.
okay, last category, facing headwinds. Airlines and other travel-related companies, these are cyclical businesses, right? They do well when the economy's strong. How does this specific mix of risk-off sentiment and weaker data hit them?
They get hit from sort of two directions. You could call it a discretionary pincer movement. It affects both their potential revenue and their financial structure.
Okay, discretionary pincer, what's the first part?
The first part is the hit to discretionary demand. Think about it. You've got worries about a government shutdown, maybe news about jobs softening.
Yeah.
How does that make the average person feel?
A bit nervous about spending, probably.
Exactly. And what's one of the first things people cut back on when they feel uncertain about their finances or the political environment?
Big trips, vacations.
Bingo.
Yeah.
Discretionary travel, family holidays, weekend breaks, maybe even some business trips that aren't absolutely essential. People postpone those plans. Airlines see weaker forward bookings. They might even have to discount tickets to fill seats. That puts immediate pressure on their revenue forecasts.
And the shutdown risk itself must be a direct operational headache for them too.
Yeah.
ATC staffing, government travel freezing up.
Oh, absolutely. The operational side is huge.
Yeah.
Even just the threat of disruptions can cause chaos and deter people from flying. But the second part of the pincer is maybe deeper, more structural. It's their leverage sensitivity.
Meaning they carry a lot of debt.
A lot of debt. Airlines like American, AAL, Delta, DAL, United, UAL. Running an airline is incredibly capital intensive. Buying planes, leasing planes, It costs billions. They finance that with debt and complex leases.
Okay.
So when the market goes risk-off, when investors get nervous about political uncertainty or a slowing economy, they get particularly worried about companies that have, one, high debt levels, and two, revenues that depend heavily on consumers feeling good and spending money.
Airlines tick both boxes.
They tick both boxes quite loudly. So investors start looking at that pile of debt and thinking, if travel demand really weakens, can they still comfortably pay this off? That skepticism, that increased perceived risk, puts pressure on their stock price, even if nothing catastrophic has happened yet.
Got it. So less demand potentially coming in the door, and the debt they already have suddenly looks scarier to the market.
That's the squeeze. Lower potential revenue and higher perceived financial risk due to their leverage. It's a tough spot for them in this environment. Hashtag tag outro.
Okay, so stepping back, this analysis paints a pretty clear picture, doesn't it? Money flowed based on these conflicting signals, political caution pushing one way, expected Fed easing pulling another. To sum it up, assets linked directly to metals, like the miners, and sectors that really benefit from cheaper debt, especially REITs, came out as winners.
Right. They saw either direct margin boosts from the higher commodity price, or they got relief on financing costs and a lift in asset valuations from those lower rate expectations.
And on the other side, the pressure fell on financial institutions like the big banks facing that in-time compression. Luxury retailers getting hit by rising input costs for gold.
Yep. Margin squeeze there.
And heavily indebted cyclical sectors like airlines facing both potentially weaker demand and nervousness about their bet load.
It really highlights how interconnected these factors are. Political risk, economic data, Fed expectations, they don't happen in isolation.
So maybe one final thought for listeners to consider from all this.
I think one thing to reflect on is just the speed and efficiency of it all. You get one piece of data, like those ADP payroll numbers, and almost instantly you see algorithms and traders react, moving billions of dollars based on how they expect the Fed will respond down the line.
It's like these pre-programmed feedback loops.
Exactly. Understanding those assumptions and those rapid feedback loops is really key to making sense of these kinds of trading moves as they happen.
Okay, that's a great point to end on. Now, we do need to say this clearly. Please remember, this analysis is purely the opinion of the author of the material we reviewed. This is not financial advice, and it is not a recommendation to buy or sell any security. Thank you for tuning in to Breaking News to Trading Moves.